Before transforming these values into more presentable numbers, let's plot them on a graph. No surprise, this can be done easily with just a couple of lines of code. From the newly created simple return column, we can obtain a plot with the size of the figure of, say, 8 and 5. These two values won't affect the labels on your graph. They simply determine the size of the graph in the output field. Basically, in this cell, we asked Python to create a graph. If we executed, the plot won't be immediately shown on your screens. The way we do it is to apply the show method. Let's run this cell. Beautiful! Did you expect some sort of a line graph? Well, that's not the case, as these are simply the daily returns that were observed throughout the period. Quite often, positive returns have been followed by negative returns. As you can see, the most significant daily observations were mainly negative. In finance, we are accustomed to seeing negative returns that have a much higher magnitude of positive returns. Usually, positive returns accumulate over time, and stock prices increase. But when things do go wrong, stock prices tend to fall very quickly, as you can see here, a loss of 30% in a single day. However, an investor who is interested in buying a stock and holding it in the long run is mainly interested in the average rate of return that the stock will have, right? Let's calculate the mean return of P&G throughout the period under analysis. A method called mean allows us to obtain the average daily rate of return straight away. This number looks really small. It is much lower than 1%. is it possible to interpret it meaningfully? Well, an average annual rate of return will tell us a lot more, right? Remember the following trick. The data we extracted is not composed of 365 observations per year. It excludes non-trading days such as Saturdays, Sundays, and bank holidays. The number of trading days per year is around 250, sometimes 251, at other times 252. So, let's use the number 250. I will multiply the average daily return by 250 and will obtain a very close approximation of the actual average return per year. This value looks more credible, doesn't it? Let's round it a little. To make it more presentable, we can multiply it by 100, turn it into a string, and finally add the percentage sign at the end. Here's our great-looking output. In this video, you saw how to estimate simple market returns of a given stock, how to plot it, and how to turn it into a meaningful value that is easy to interpret. That's a great start. Take a little breath, and in the next lecture, we will analogically calculate the logarithmic returns of the same stock. Thanks for watching. In the previous lecture, we learned how to calculate a stock's simple rate of return. However, you should be aware that there is an alternative way to calculate returns. Instead of simple rates of return, we could use logarithmic rates of return, also called log returns. The difference between the two approaches is quite subtle. As we discussed in our previous financial lecture, given that we will explore the behavior of a single stock from the 1st of January 1995 until today, perhaps it will be better to use log returns. Again, NumPy will be the library that will provide us with the necessary tools for this computation. The benefit is that this package offers the possibility of vectorized computation. This term refers to the ability to organize several kinds of data processing tasks as array expressions, vectors, matrices, or multidimensional arrays. The alternative is writing loops, but that could be a tedious job and will require more computation time. In other words, NumPy is Python's extension that allows us to replace loops with one-dimensional or multidimensional arrays. This operation is called vectorization, and the relevant type of programming that supports it is array programming. Okay, so, as we agreed, to calculate log returns, we will have to take the logarithm of the price in time t divided by the price in t minus 1. Okay, so the first log return will be equal to the logarithm of the price on the 4th of January 1995 divided by the price on the 3rd of January 1995. We will need a new column, which will be called log return. The expression we will assign to it will be the following. Call the log function from the NumPy package. And in the parentheses, type the formula for calculating the logarithmic rate of return. That would mean taking the adjusted close of a given observation for a certain trading day and dividing it by the adjusted close of the day before. Again, we must specify the adjusted close data in brackets. And, just as we did before, we will use the shift function to lag the stock price observations in the denominator. The argument of the shift function is 1, as we need to lag the time series by a single observation. Great! We obtain a series again, and most of the values are less than 1%. When we plot the newly obtained data on a graph, we see the log rate of return ostensibly resembles the simple rate of return. However, when we calculate the average daily and annual log returns, we obtain a percentage that is significantly smaller than the one we obtained for simple returns. In general, it is preferable to use simple returns when we calculate the returns of multiple securities in the same period. On the other hand, log returns are a better choice when we have only one security and calculate its return over multiple time periods. Okay, great. Our first task is complete. Thanks for watching.
So far, we've considered an investor who owns only one stock, but that's rarely the case. Most investors own several stocks, and the set of stocks that an investor owns is called his investment portfolio. Every investor tries to select and add stocks that will optimize the overall rate of return of his portfolio. But before diving in and considering portfolio optimization strategies, we need to learn how to calculate the rate of return of a portfolio. Let's use an example of a simple portfolio composed of 4 stocks. The 4 equity stocks are Apple, IBM, GE, and the Ford Motor Company. Perfect. The average annual rate of return of these stocks is provided on the right side. We want to calculate the historical rate of return of a portfolio that contains these 4 stocks. This will show us the rate of return that can be expected from this portfolio in the future. Right. Calculating the rate of return of a portfolio is an easy and intuitive task. We have the rates of return of individual securities, and we only have to multiply each security's rate of return by the weight it has in the overall portfolio. So, if this is an equally weighted portfolio, each stock will have a weight of 25%. Then we have to multiply these weights by the rate of return of the 4 stocks. I'll multiply 25% by Apple's rate of return, 25% by IBM's return, 25% by GE's return, and 25% by Ford's return. The sum of the 4 components gives us the rate of return of the portfolio. Great! What if this wasn't an equally weighted portfolio? If the weights of these 4 stocks were 40% Apple, 40% IBM, 15% GE, and 5% Ford, the calculation will be the same. And the only difference is that we must substitute 25% with the new weights. Here's what we'll have in this case. The second portfolio earns a higher rate of return. Next, we will apply what we have learned here and calculate a portfolio's rate of return in Python.
Right. Excellent. Now that we know what a portfolio of financial securities is, let's apply what we learned in the previous lecture in Python. To do that, we will work with a hypothetical portfolio composed of Procter & Gamble, Microsoft, Ford, and General Electric stocks. So, the code that you see here starts in the following way. In the beginning, we use the first few cells to load the data from Yahoo Finance. It is done in the same way as we showed you a few lectures ago. Once we've loaded the data, we are ready to perform an ordinary check. The result shows us the data is clean, complete, and well organized, containing the same amount of observations for each of the 4 securities. The beginning and ending values look reasonable too. Just to be certain, let's do a quick check of Yahoo's website. Okay, as you can see, P&G's latest closing price corresponds to the value we see here. Excellent. Our next task will be to create a line chart, which will allow us to understand how these securities perform throughout the time frame under consideration. This formula helps us normalize the data to 100. The iLoc indexer with 0 between the brackets will extract the data from the first column of the table. Yep, true. We just obtained the first row of the entire data. So, the formula will first divide the adjusted price value of a certain date by the very first number, and then we'll multiply the obtained quotient by 100. We say this calculation will normalize our data to 100. This is a mathematical trick. The first row divided by itself will always produce 1. Multiplied by 100 will give 100. That's why in the graph, all the lines initiate from the vertical axis at the point corresponding to the value of 100. The idea behind this operation is to compare the behavior of the 4 different stocks as if they were all starting from the same value, 100. If we don't do this, we will see the adjusted closing prices of all companies plotted directly, and we will not have a good landmark. Normalization tackles this issue and is a practice every financier applies in his work. Before discussing the lines on the graph, let me make a quick Python observation. In the supporting notebook document, we explain how log and ilog work. Well, to apply log, we'll have to indicate the precise label corresponding to the first row. Why? Because the dates are labels, and that's the requirement to use log. Alternatively, to use ilog, we need to leave a simple indication of the position of interest, 0, given we are interested in the first row. Both approaches lead to the same outcome. There are advantages to using one instead of the other in different data sets. Here, ilog 0 is shorter to type and is more intuitive to use, indicating clearly that we will refer to the closing prices of the first registered trading day. Okay, end of note. So, to interpret the graph, we must say Microsoft is a fair winner. It beats the other stocks regarding stock price performance. From 1995 until the end of 2007, the moment of the global financial crisis, General Electric performed better than Procter & Gamble, but apparently, it could not sustain the tumble. Procter & Gamble shares have cost more ever since. Finally, Ford enjoyed a short-time lead over P&G, but that was all. Their adjusted close price has since remained relatively low. Good. In theory, if past performance is indicative of expected future performance, this type of analysis could help you understand which stocks performed better historically. Okay. The next task on our agenda will be to calculate the simple return of these stocks and create a new table with them. Why simple returns? Because it is the preferred approach when we investigate a few stocks over the same time period. Remember? Do you remember how you can create a NumPy array? This is a perfect situation where we can apply this technique. Assume equal weights of 0.25 for all 4 stocks, because a portfolio's weights must always sum up to 1. We are working with a single portfolio. Okay, so what we still need to do is calculate the product of the weight of each stock by its return, right? This will be equivalent to a matrix multiplication in mathematics. We will need NumPy's dot method. It allows us to calculate vector or matrix products straight away. Moreover, in Pythonic, the one or multidimensional array we obtained is referred to as the dot product between the variables. By doing this, we'll multiply each stock's weight and its respective return. What are we waiting for? Let's apply the dot method to the returns we obtained and the portfolio weights we created. Great! Or not so great, actually. Didn't we expect to see a number here? A number that tells us what the entire portfolio return will be? So why did we get an entire array? Because we multiplied each value from the returns table with the weights quoted. We forgot to estimate the average return of each stock's price first. Let's assign the average yearly returns of the 4 stocks to the variable annual returns. Okay, these are the 4 stocks' annual returns. Let's try estimating the dot product now. Good, we obtained a single number. Awesome! Let's store this as a beautiful percentage value containing only 3 digits after the decimal point. This line of code lets us do that. Bingo! 14% approximately. To compare this combination with the performance of another portfolio, we must assign new weights for each stock. We already know the mechanics, and we have calculated the annual returns. So, we need to go through the same steps to obtain the return of the second portfolio. I will set the weights like the ones we mentioned earlier, 0.4, 0.4, 0.15, and 0.05. We take the dot product of the annual returns and the second set of weights, and then print it out together with the other portfolio return value. Presented this way, one above the other, it is easy to see which portfolio had a greater return, right? Well done! Feel free to apply to practice what you learned in this lesson by solving the exercise task attached to it. Good luck, and thanks for watching.
A market index provides an idea about how a given stock market is performing. It represents a large enough sample of the overall number of stocks in that market and can be considered a good enough proxy of the overall development of the market. It would be too difficult to measure the development of every security traded in a stock exchange. Some securities are small, and their shares are not even traded daily. That's why practitioners use market indices to provide an idea of the overall market performance. The 3 most famous indices in the U.S. are the S&P 500, Dow Jones Industrial Average, and NASDAQ. The S&P 500 comprises 500 of the largest listed companies. The diverse constituency of the S&P 500 makes it a true approximation of the U.S. stock market. It is a market cap weighted index, so companies are weighted according to their market value. If the market cap of P&G is 3 times the market cap of Nike, a 1% change in P&G's share price will have 3 times the impact of a 1% change in Nike's price. The Dow Jones Industrial Average Index uses an average of 30 large public stocks traded in the U.S. market. The Dow Jones Industrial Average is one of the oldest indices calculated historically. However, it cannot be used as a representation of the U.S. stock market because it includes only 30 stocks. The other important U.S. index we'll cover is the NASDAQ Composite Index. It is an index grouping some securities that are listed on the NASDAQ stock exchange. Most companies listed there are information technology companies, and NASDAQ shows us about the rate of return of tech stocks. All right, very good. These are the 3 important U.S. indices. Let's look at some foreign indices well known for professional investors. Examples of such indices are the FTSE 100 in the UK, the DAX in Germany, the Nikkei 225 in Japan, and the SSE Composite Index in China. There are some global stock indices as well. Morgan Stanley's Morgan Stanley Capital International, MSCI. This index includes stocks from all developed markets in the world. Okay, excellent. So, why is it important to know what stock indices are, and how are they performing at a given time? If you want to understand whether one of the stocks you own is performing well, one of the best comparators you can use is a stock index. Compare the stock against the overall market performance. In addition, a stock index gives you a sense of the type of return you can expect if you invest in a well-diversified portfolio in a given market. Let's see how we can calculate the historical returns of some stock indices we mentioned in this lesson. It will be interesting to observe how much the rates of return of the S&P 500, the Nasdaq, and some foreign indices were. We'll do that in our next lesson.
We're doing really great. Now that we have learned more about stock returns and what stock indices are, it will be great to learn how to calculate their performance in Python. The libraries we import are the same as before, and the tickers we use are the ones of the S&P 500, Nasdaq, the German DAX, and the London Financial Times Stock Exchange, informally called FTSE. Observe how a hat is added before each ticker. This is to indicate we are dealing with market index data. If the German DAX symbol and the London's FTSE seem intuitive, for some reason GSPC refers to the S&P's 500, while IXIC will provide us Nasdaq data. They can be a bit more confusing, but after a while, you'll get used to these acronyms. All right? We are extracting data for the last 20 years, so the first value will be the 1st of January 1997. The first thing we can easily notice is that the values of indices are much higher with respect to the adjusted closing prices of the companies we saw earlier. However, that's natural, given that indices are baskets composed of many stocks. Okay, let's plot this data on a graph. As we did before, we will normalize it to 100 again. Let's interpret the chart for a while. Around the millennium, we observe a general rise of the indices value. This was because in the period between 1995 and 2001, there was a dot-com bubble, and the stock markets in industrialized countries like USA, UK, and Germany were boosted by a significant rise in the value of internet companies. Being composed primarily of tech companies, Nasdaq logically depicts best this trend. Relative to the other indices, in a certain period its performance declines abruptly. In the next few years, Germany manifests stability and growth. Of course, the global economic and financial crises of 2007-2008, as well as the sovereign debt crisis in 2011, reflect the picture accordingly. But, in the long term, observing the results from 1997 until today, we can say that overall, all indices perform very well, with only an occasional drop of the FTSE below the initial growth level. Nasdaq scores highest in certain periods, and its performance is connected to slightly sharper variations at times. The German market is the one that demonstrates real persistence and stability. Great. Let's support this analysis with a few numbers. We must calculate the indices' simple returns. The output of this cell shows namely the annual returns. Wonderful! We were reasoning correctly. All four numbers are positive. The implication is that the average of the companies listed under the four indices has provided investors with a positive rate of return over the past 2 decades. Moreover, if we wondered whether Nasdaq or S&P 500 produced better results, here's the answer. Apparently, at least for this time span, Nasdaq surpasses the S&P 500 easily. The S&P 500 comes in third actually, because the German DAX outperformed it. Finally, let's put the adjusted closing price of a company and compare its performance with one of the indices. Let's opt for Standard & Poor's once more, and then include Dow Jones Industrial Average. The latter is an index, which aggregates the prices of 30 major U.S.-listed companies and attributes to them equal weights. It is a good indicator of the trend in the American economic system. Right. We see the numbers in the 3 columns. They go from below 100 to more than 20,000 units. Does that frighten us? Not at all. We know what to do. We will normalize our data. And when we do that, we will be able to see that P&G did better for the past 10 years. This is how we can compare the performance of stocks and stock indices, the first type of analysis that you need to perform when analyzing the stock market. Are you excited? Good. The topics we will see next will become more and more interesting. Thanks for watching.
Investors love earning a great rate of return. And that's clear. They don't like risk, uncertainty, the chance of losing a large portion of their money. We said risk and return are the two most important dimensions in investment decision-making. Therefore, it is easy to understand why we must spend a good portion of time to learn how to measure and forecast a security's risk. How can we define risk for an investor? If you invest $1,000 of your money in a stock that's trading on the stock exchange, and you know that, on average, this stock earned 15%, you would want to know how the average was made, right? Whether the stock earned 14% in 1 year, then 16% the next year, 13% the year after that, and 17% in the last year of historical observations. Or whether it earned plus 50%, minus 20%, minus 20% again, and then plus 50% in the final year. There's a big difference between the two sets of data, right? In the first case, you can be certain your money will earn an amount that is more or less in line with what you expect. Things can be slightly better or slightly worse, but the rate of return is always 13 to 17%. Things change dramatically with the second set of data. There is a huge variability from 1 year to the next. The average return is the same, however, you can't have an idea about what comes next. If you are an investor who holds the stock for 2 years, you can lose 40% of its value if the years when you hold the stock are years 2 and 3. So, apparently, variability plays an important role in the world of finance. It is the best measure of risk we have. A volatile stock market is much more likely to deviate from its historical returns and surprise investors negatively. Yes, it can surprise investors positively too. However, investors don't like surprises and are much more sensitive to the possibility of losing their initial investment. Most people prefer to have a good idea about the rate of return they can expect from a security or a portfolio of securities, and are doing their best to reduce the risk they are exposed to. We need to remember that investors are risk-averse. They don't like risk for the sake of risk, and their main goal is to measure the risk they are facing and reduce it as much as possible. Commonly used statistical measures, such as variance and standard deviation, can help us a great deal when we try to quantify risk associated with the dispersion in the likely outcome. Such dispersion is measured by a security's variance and standard deviation. To be even more precise, the variance of a security measures the dispersion of a set of data points around their mean value. It is equal to the following algebra equation. The variance, S squared, is equal to the sum of the squares of the difference between a data point x and the mean divided by n minus 1. For those of you who haven't seen it, here is an example that should make things easier. The mean of the 4 data points is 15%, right? Great. Let's calculate the dispersion of each of the 4 points from the mean and elevate to the second degree. We'll have 14% minus 15% to the second degree, 16% minus 15% to the second degree, 13% minus 15% to the second degree, and 17% minus 15% to the second degree. These are the 4 dispersions from the mean elevated to the second degree. Let's calculate their sum. Once we have the sum, we have to divide by the number of observations we've had minus 1. Here, we had 4 observations, so we'll have 4 minus 1. I'll divide by 3. The variance is equal to 0.00033. If we take the square root of the variance, we'll obtain the standard deviation of this sample of observations, which is equal to 1.8%. Let's calculate the variance of the second set of numbers. We have to use the same formula for the 4 observations we have here. 50% minus 15% to the second degree, minus 20% minus 15% to the second degree. Again, minus 20% minus 15% to the second degree. And finally, 50% minus 15% to the second degree. Let's sum the 4 components, divide by 3, and obtain the variance. As you can see, it is much larger in this case, 0.16. And the standard deviation is even higher, 40%. But we kind of expected it, didn't we? In this example, we knew the lowest and the highest returns were 35% away from the average value of 15%. So we obtained a close approximation once more. The second set of returns had a much larger dispersion and is a lot riskier. This is how we can calculate a stock's variance and standard deviation. We're doing well. In our next lesson, we'll learn how to do this in Python. Thanks for watching.
The focus of this lecture will be the calculations of a securities risk. I am sure you know the code written in the first 2 cells and quickly understand what we are doing. The same libraries are imported, and data from Yahoo Finance is downloaded, saved in a data frame object called security data. We must pay attention that we are extracting the right companies and the time span of the extraction is correct. The 2 companies we have chosen here are P&G and its German peer, Beiersdorf. Hence, we will need the tickers PG and BEI.DE. We will examine the behavior of the 2 stocks for the past 10 years, retrieving data from the 1st of January 2007. Okay, perfect. Let's talk finance. The standard deviation of a company's returns can also be called a risk or volatility. A stock whose returns show large deviation from its mean is said to be more volatile. Right. So, let's see the stocks of which company are riskier or more volatile. First, we take the logarithmic returns because we will examine each company separately in the given time frame, and this approach will tell us more about the behavior of the stock. We will store this data in a new table called security returns. Okay, this newly created table has 2 columns. Each contains the log returns of P&G and Beiersdorf respectively. And this allows us to obtain the mean and the standard deviation of the 2 stocks for the data frame. To do that, abide by the following syntax. After the name of the object, which will be the data frame with the log returns, security returns, specify the name of the columns in brackets. Then, apply the method called mean. We obtained a small number. It equals the daily average return. Let's annualize this value, multiplying it by the number of trading days in a year, 250. Good. We obtained a value slightly above 6%, which is the annual rate of return. The same Pythonic logic must be applied to the calculation of the volatility of this company's stock. The method we will need is called STD, an acronym for standard deviation. To annualize this figure, besides multiplying it by 250, don't forget to raise to the power of 0.5. You will take the square root of 250, and you should not forget to do this, because the standard deviation is, per se, square root of the variance. Next, we repeat the same procedure for Beiersdorf. We get a higher mean, but also a higher volatility percentage. See? It would be easier for us to interpret the results if we quoted the two means and the two standard deviations, one next to the other, right? To achieve this, one way would be to print the equations of the two annualized means. And here's what we obtained. The second way is more stylish, but is trickier. From the security returns data, we could extract the mean of both companies after writing one line of code. We must enlist their tickers, separated by a comma. Apparently, this would not be enough, since the output of this cell shows an error. NumPy has the answer to this issue. The means and the standard deviations we obtained were all elements of one-dimensional arrays. They were also float values. Here, we are trying to include two values in a new NumPy object. There cannot be a floating point with two values, right? A float can only contain a single value. Therefore, we must create an array with two dimensions. Briefly, each pair of brackets we surround our column names with will increase the number of dimensions of the newly created NumPy object by 1. Hence, we can correct our code by using double instead of single brackets. In this specific lecture, we could have coped without using NumPy, but it is important you pay attention to the difference between using single or double brackets, because if you have to program advanced mathematical operations that involve matrix multiplication, for instance, this part of the Pythonic syntax will be problem solver number 1. We will make sure we show you such an example in one of our next videos. By using this technique, we can obtain the means and the risk values of both companies. This implies we have recorded the mean values of P&G and of Beiersdorf's returns as elements in one matrix and the values of their standard deviations in another matrix. This lesson reinforces what we learned in our previous lecture, right? Stocks with higher expected return often embed more risk. Beiersdorf's rate of return is slightly higher. However, this comes at the expense of a higher volatility. Thanks for watching.
In this lesson, we will talk about one of the most important concepts in finance, the relationship between financial securities. It is reasonable to expect the prices of shares in a stock exchange are influenced by the same factors. The most obvious example is the development of the economy. In general, favorable macroeconomic conditions facilitate the business of all companies. When people have jobs and some money in their pockets, they will spend more, and companies benefit from that as their revenues increase. In a tough economy, consumers reduce their spending and buy mainly products of primary importance. And because stock prices are determined by profits, whenever the economy is doing good, stock prices are higher. Investors will pay a high price for profitable companies. In times of recession, companies' profits are lower and share prices fall significantly. So that's one important relationship. Companies' shares are influenced by the state of the economy. However, different industries are influenced in a different way, and that would be a correct observation. Who do you think will suffer more at a time of crisis? Car makers or supermarket chains? Of course, car makers. People can't stop buying food and groceries, but they can easily postpone buying a new car and continue driving an old vehicle. Therefore, the state of the economy impacts different industries in a different way. How important is this to an investor building a portfolio of stocks? It is very important. Try to imagine the following scenario. You own one stock of a tech company, let's say Facebook, okay? You have some savings, and you would like to use it to buy the shares of a second company. The two options you can choose from are LinkedIn and Walmart. Let's assume you expect the same rate of return from the two shares, which is probably unrealistic but will serve us well for this example. So, all else being equal, are you going to choose LinkedIn or Walmart? The right answer would be Walmart, right? And the reason for that is Walmart operates in a different industry, and this gives you protection as an investor. If things don't go well in the internet space, advertising spending decreases, competition becomes stronger, a new player enters the market, technology changes rapidly, there can be many problems in any sector, you want to be protected. You would still have one share of Walmart, which will not suffer from a potentially negative development. And the same is valid for the retail sector. If Walmart isn't performing as well as expected, you would still have your Facebook share, which operates in a different industry. By buying the shares of two companies operating in the same industry, your portfolio would have been exposed to an excessive risk for the same level of expected return. So clearly, there is a relationship between the prices of different companies, and it is very important to understand what causes this relationship and how to use this measurement to build optimal investment portfolios. We'll learn how to measure the relationship between two variables in our next lesson. See you there. All right, excellent. Now that we know it is reasonable to expect there will be a relationship between the returns of stocks, we have to learn how to quantify this relationship. Let's zoom out and think of an example that is easy to understand and will help us grasp the nature of the relationship between two variables a little better. Which is one of the main factors that determine house prices? Their size, right? Typically, larger houses are more expensive, as people like having extra space. The table you see here shows us data about several houses. On the left side, we can see the size of each house, and on the right, we have the price at which it's been listed in a local newspaper. We can order these data points in an XY plot. The x-axis will show us a house's size, and the y-axis will provide information about its price. I am sure you notice a pattern. There is a clear relationship between these variables. Statisticians use the term correlation to measure such relationship. The final output of the calculation lies in the interval from -1 to 1. To understand the concept better, I would like to show you the formula that allows us to calculate the correlation between two variables. Here it is. Don't be scared, please. Let's apply it in practice for the example we saw earlier. X will be house size, and Y stands for house prices. So, we need to calculate the average house size and the average house price. That's straightforward, isn't it? I only have to sum the sizes of all houses and then divide by the number of houses we have. I'll do the same for house prices. Okay, excellent. This is the average house size and the average house price in our example. Now, let's calculate the nominator of the covariance function. Starting with the first house, I'll multiply the difference between its size and the average house size by the difference between the price of the same house and the average house price. Once we're ready, we have to perform this calculation for all houses we have in the table, and then sum the numbers we've obtained. Great! This gives us the nominator. It gives us a sense of the direction in which the two variables are moving. If they move in the same direction, the covariance will have a positive sign. If they move in opposite directions, the covariance will have a negative sign. And if their movements are independent, the covariance between the house size and its price will be equal to 0. There is one problem with covariance, though. It could be a number like 5 or 50, but it can be something like 0.0023456. Totally different values. How could one interpret such numbers? Proceed to the next lecture and find out why correlation helps us solve this issue and understand the two concepts a little better. Thanks for watching. Correlation adjusts covariance, so the relationship between the two variables becomes easy and intuitive to interpret. Now, A correlation of 1, also known as perfect positive correlation, means the entire variability of the second variable is explained by the first variable. In our case, this means that for every additional square foot of size, we would expect an increase of, let's say, $1,000 in the house price. 5 additional square feet will lead to a price increase of $5,000. 10 additional square feet to a price increase of $10,000, and so on. The observations in our plot will form a straight line, as the correlation between size and price must be perfect. It would mean size is the only variable that determines a house's price, and we can easily calculate a house's price if we know its size. The correlation is deemed positive because when we add plus 1 additional square foot, the price goes up plus $1,000. It moves in the same direction. Okay, it is easy to understand that in real-life situations, we can rarely see a perfect correlation. It is much likelier to observe an imperfect correlation, such as the one we saw earlier. Yes, size is one of the most important variables that determine house prices, but it isn't the only one. Other factors, such as location and year of construction, are very important to buyers. So we can't expect that a house will be purely valued based on its size. And that's how it works with most things. Even company shares. There are several variables that determine share prices: industry growth, revenue growth, profitability, regulatory environment, growth perspectives. Tens of variables. The more similar the context in which two companies operate, the more correlation there will be between their share prices, as they will be influenced by the same or similar factors. It makes sense, doesn't it? A correlation of 0 between two variables means they are independent from each other. We would expect a correlation of 0 between the price of coffee in Brazil and the price of houses in London, right? The two variables have nothing in common. And finally, we can have a negative correlation coefficient. It can be a perfect negative correlation of -1, or much likelier, an imperfect negative correlation of a value between -1 and 0. Think of the following businesses: a company producing ice cream and a company selling umbrellas. Ice cream is sold more when the weather is very good, and people buy umbrellas when it's rainy. Obviously, there's a negative correlation between the two, so when one of the companies makes more money, the other won't. This is an example of a situation where the prices of two companies are influenced by the same variable, but the variable impacts their businesses in a different way. Okay, very good. This is how we can calculate a correlation coefficient manually. The truth is, though, no one does this nowadays. People use different software packages. In our next lesson, we'll learn how to calculate the covariance and the correlation between the prices of two companies, Procter & Gamble and Beiersdorf. It will be a lot easier and significantly faster as we will use Python. Thank you for watching.
Okay, so let's see how we can apply in Python what we learned about covariance and correlation. Now that you know what covariance is, you can grasp the concept of a covariance matrix more easily. It is a representation of the way two or more variables relate to each other. The covariance between a variable and itself is the variance of that same variable, actually. So, along the main diagonal, you will have the variances of the variables, and the rest of the table will be filled with the covariances between them. Great. In our case, the variables are two stock prices. Therefore, we will expect a 2x2 covariance matrix with the variances of each stock along the main diagonal and the covariance between the two stocks displayed in the other two cells. In Python, there is no need to do mathematical calculations manually, The NumPy's var method calculates the variance of an object for us. We use it to calculate the variances of the stock prices of Procter & Gamble and Beiersdorf. We annualize these values right after that. At this stage, it is unnecessary to create a data frame and fill in each cell with values. The cov method, whose name comes from the term covariance, does this for us automatically. In the second cell, we annualize the result to obtain the annual covariance matrix. Let's examine this matrix cell by cell. The cell in the top left corner shows us the variance of the P&G stock. Is it so? Let's check. Yes, 100%. The cell in the bottom right corner represents the variance of the other stock we are examining, Beiersdorf. Check. The cov method is useful because it allows us to obtain the other number more easily. The remaining two cells show the same value because the covariance between P&G and Beiersdorf and the covariance between Beiersdorf and P&G is the same. Okay, very nice. Now, let's calculate the correlation with the help of the core method. Along the main diagonal, we see exactly 1. Why? Because we divide the variances of P&G and Beiersdorf by the same values. And it makes sense that the movement of a stock is perfectly correlated with itself, right? Here's the correlation formula. The product of the standard deviation of x and the standard deviation of x is the variance of x. Remember that. As was the case with the covariance matrix, the other two cells in the correlation table contain the same number. They tell us the stock returns of the two companies are weakly correlated. And be very careful here. This is not the correlation between the price of the two equities. This distinction often creates confusion when carrying out financial analysis. Correlation between prices and correlation between returns may show different values. They usually have different implications, and it is important to respect this distinction. Briefly, the correlation between returns, which is the same as to say the correlation between the rate of returns, reflects the dependence between prices at different times and focuses on the returns of your portfolio, rather than on stock price levels. As an investor, return is what you care about, not the nominal price of the stock, right? You want to know how much you will earn after investing in a certain company, not the quoted price of its shares. Finally, don't fall in the trap of annualizing the correlation table. It does not contain average daily values. It shows us the relation that exists between the two variables. So we need not multiply by 250. In this lecture, we presented a very important concept. Python can help you estimate certain measures, but it is not capable of providing perfect economic and financial rationale. It is your job to step in and interpret the numbers. I hope you had fun watching this video. See you in the next one.
Previously, we learned how to measure the variability of a financial security and agreed this is one of the best measures of risk we can use. We learned a volatile stock is much likelier to deviate from its historical returns and surprise investors. That's excellent. Now is the time to consider a portfolio of at least 2 stocks. We learned how to calculate the expected rate of return of portfolios with 2 or more stocks, but we haven't discussed the calculation of a portfolio variance. If a portfolio contains 2 stocks, its risk will be a function of the variances of the 2 stocks and of the correlation between them. Remember the example about Facebook, LinkedIn, and Walmart? It is reasonable to expect a portfolio containing Facebook and LinkedIn shares will have a different risk compared to a portfolio containing Facebook and Walmart, even if the variances of LinkedIn and Walmart were the same. The difference will be given by the relationship between the prices of the two companies in the portfolio. Okay, let's remember basic algebra, shall we? The sum of a plus b to the second degree is equal to a squared plus 2 times ab plus b squared times ab, correct? Remember that? So you did pay attention at school. Great, we did too. Let's do the same thing for a portfolio containing two stocks. The first stock has a weight of W1, which stands for weight 1, and the second stock has a weight of W2, which stands for weight 2. It is important to mention the sum of the weights is always equal to 1, because the weights must add up to 1, as these are the two stocks forming the entire portfolio. 100% of it, or simply 1. The portfolio variance will be given by weight 1 times the standard deviation of the first stock plus weight 2 times the standard deviation of the second stock to the second degree. The result is the same as the formula we have above. Weight 1 times the standard deviation of the first stock plays the role of A, while weight 2 times the standard deviation of the second stock is B. And the end result is equal to weight 1 to the second degree times the variance of the first stock plus weight 2 to the second degree times the variance of the second stock plus 2 times the product of weight 1, weight 2, and the covariance between the two stocks. Here it is. This is how we calculate a portfolio's variance. It depends on two things: the standard deviations of the two stocks and the correlation between these stocks. In our next lesson, we'll apply what we have learned in practice. Thanks for watching.
Right. So, in this lesson, we will show you a wonderful NumPy technique that will facilitate all the matrix manipulations you will have to perform in Python. This tool is frequently used, especially in finance. We will simply continue with the Jupyter Notebook file we used in our previous 2 Python lectures. To remind you, the companies we are working with are P&G and Beiersdorf, and the time frame starts from the 1st of January 2007. Assume we have an equally weighted portfolio invested 50% in P&G and 50% in Beiersdorf. We will have to save these values in a NumPy array called weights. The code in the next line entails matrix multiplication. We will not go into much detail, but if A and B are numbers, it is straightforward to estimate A times B to the power of 2. But when using matrices and vectors, the algebraic calculation looks like this. The transposed version of the weights vector must be multiplied by the annualized covariance matrix, and then we should multiply by the normal weights vector. This whole structure will produce a single number. NumPy's dot product makes this operation intuitive to implement. To get the transposed weights vector, use the .t notation after the name of the weights object, and then take the dot product of the annualized covariance matrix and the weights vector. This line's output is the portfolio variance we studied in our previous lecture. If we are interested in the portfolio's volatility, we should raise the expression to the power of 0.5. Great! This time, we did the calculations quickly. Why complicate things if we can use NumPy's dot product formula, right? The classic mathematical computation would have taken us much longer. The same dot product structure can be used when calculating the risk of investing in a multi-asset portfolio, where larger weights and covariance matrices will be involved. In our next lesson, We will split the portfolio volatility risk into two parts and explain their meaning. Thanks for watching.
We learned that a portfolio's risk can be described as the sum of two components: the variances of the securities contained in the portfolio and the products of the covariances between securities and their standard deviations. And we are ready to introduce a very important concept. There are two types of investment risk: systematic and unsystematic risk, also known as undiversifiable and diversifiable risk. The first component, the variances of the securities in a portfolio, can be seen as undiversifiable risk. Regardless of the number of securities contained in a portfolio and the relationship between these securities, this component will continue to exist. This is the uncertainty that is characteristic of the entire market. Systematic risk is made of the day-to-day changes in stock prices and is caused by events that affect all companies. A recession of the economy is one systematic risk. Other systematic risks can be unfavorable consumer demand, wars, earthquakes, and all risks capable of affecting all companies in an economy. The uncertainty arising from systematic risk is something we have to accept when investing. Fortunately, a lot can be done about the second component, unsystematic risk, also known as idiosyncratic risk. These are company-specific, even industry-specific, risks that can be smoothed out through diversification. Academic research has shown if we build a portfolio containing at least 25 to 30 stocks that are not correlated, unsystematic risk will almost disappear. It is not a coincidence that many investment funds try to provide their clients with the opportunity to invest in an investment vehicle, like an investment fund that contains the same stocks as the S&P 500 index. If you own a portfolio of 500 stocks, the only risk you are exposed to is systematic risk, and it doesn't mean this comes at the expense of a lower expected return. Some institutional investors go even further and build portfolios of securities not from the same country, which should reduce the correlation between these securities even further and drive down the overall portfolio risk. In the next lesson, we'll try to calculate a portfolio's systematic and unsystematic risk. First, we'll do that for a portfolio of 2 stocks, and then we'll see how the overall portfolio risk changes when we add additional stocks. This is it for now. Thanks for watching.
Okay, people. With this lesson, we'll complete the section in which we studied the calculation of financial risk. Our task here is to disaggregate a portfolio's diversifiable and non-diversifiable risk. The portfolio we'll use is a simple one, containing only 2 securities. But the exact same mechanics can be applied when working with a larger portfolio. To start, we will need the weights of the 2 assets. Given this is an equally weighted portfolio of the 2 stocks, we will need a NumPy array containing twice the value of 0.5. We already created one and called it weights. The values of this array can be accessed after we index the 0 and the first position in brackets. Okay, the portfolio weights are ready. One way to estimate the annual diversifiable risk is to obtain the portfolio variance and then subtract the weighted annual variance of each stock. This occasion will allow us to emphasize the difference between creating an ND array with single or double brackets. We explained in one of our earlier videos that practically each pair of brackets around the name of the column will add 1 dimension to the NumPy array. For the sake of argument, let's use this structure to create the annual variance of each company. What record? The values of the variances of P&G and Beiersdorf not as floats, but as single elements in 1x1 matrices, that is, 2-dimensional arrays. For this reason, we should expect a wrong output when we calculate the unsystematic, or also known as diversifiable risk. The formula we have typed is correct. Well, we don't see an error, but the answer is strange anyway, right? Instead of a float, we obtain a vector with no numbers. This little exercise was to remind you to be careful when creating NumPy objects. Let's see two techniques that could help you overcome this issue. Since the variance of Procter & Gamble is stored in a 1-by-1 matrix, it will be a single value. If you apply the well-known float function, you will turn this value into a float. Nice! Alternatively, when you assign a value to PG var A, you can use single brackets when you indicate you will use data from the PG column. This will automatically store the output as a float value. The data type float64 line will disappear, and you will see more digits after the decimal point. Great! To be consistent, let's apply the second method to the annual variance of Beiersdorf as well. BEI var A will be a floating point. Good. Can we try to re-estimate the diversifiable, or also known as unsystematic, risk? Yes, we can. And we obtain a float whose transformation shows it is something smaller than a percent. Great! The remaining part of the portfolio variance is the systematic risk. As you can see, regardless of whether we subtract the unsystematic risk from the whole variance or we sum the weighted annual variances, we obtain the same value. The check we make in the last cell further confirms our results. We obtain the Boolean value true in the output as we verify the equality between the two variables. Okay, great. We are doing well. In the next chapter, we will start a new topic, regression analysis. See you there, and thanks for watching.
Regression analysis is one of the most frequently used tools in the world of finance. It quantifies the relationship between a variable, called dependent variable, and one or more explanatory variables, also called independent variables. Regression analysis can be handy when we want to forecast a future dependent variable with the help of patterns from our historical data. Let's go back to the example we mentioned before, house prices. The larger a house, the more expensive it is, right? In this relationship, we are considering two variables, the price of a house and its size. The explanatory variable is size, as it helps us explain why certain houses cost more. And the dependent variable is price, as it is being explained. And we know for a fact there is a relationship between the two. So, the basic reasoning is that if we know the value of the explanatory variable, house size, we can determine the expected value of the dependent variable, house price. There are many other factors that determine house prices. Size is one, but it is not the only one. If we use only one variable in a regression, it is called a simple regression, while regressions with more than one variable are called multivariate regressions. Simple regressions are easier to understand, so let's start by describing a simple regression. The two variables we have are x and y. Y indicates prices, and x stands for house size. Okay? We can use the xy plot we showed earlier. Each observation we see in the plot contains information about the actual size and price of houses listed in a newspaper ad. Great! We can easily see the two variables are connected. Larger houses have higher prices. Regression analysis assumes the existence of a linear relationship between the two variables. One straight line is the best fit and can help us describe the rapport between all the data points we see in the plot. How do we determine which is the best line that will help us describe the relationship between house prices and house size? Well, we simply have to find a line that minimizes the error observed between itself and actual observations. See how different observations tend to deviate? A linear regression will calculate the error observed when using different lines, and will determine which one contains the least error. Each deviation from the line is an error, because it deviates from the prediction the line would have provided. We have all done basic algebra, right? Remember the equation of a straight line, also known as a linear equation? It is y equals mx plus b, where m is the slope of the line and b is the y-intercept. Great! Given this is a linear regression and its output is a line, we would expect to obtain an equation with a very similar shape to this one. Most textbooks show it as y equals alpha plus beta times x. But that's basically the same, isn't it? Alpha replaces b and beta replaces m. Perfect. Later, we'll explain the financial meanings of the alpha and beta coefficients. However, before doing that, we will learn how to distinguish between regressions that are solid in terms of predictive capabilities and regressions that are weak and unreliable.
Congratulations on reaching this stage of the course. By now, you've learned how to write code in Python and have grasped some of the fundamentals you'd need when investing on the stock exchange. Do you feel good about what you have learned? You should, as you now know about rates of return of a stock, portfolio return, volatility, covariance, and correlation. These are all fundamental concepts in the world of finance. Starting from this lesson, we'll continue to dig deeper and learn more advanced techniques for financial analysis. Okay, perfect. Let's start with regression analysis then. There are people who devote their lives to this topic. Many econometric and statistical models use this concept. To respond to this, in Python, there are modules that help you run a huge variety of regressions. Here, we will learn about one of the most widely used types of regressions, the OLS regression. First, we are going to import a couple of modules we haven't used so far, stats from SciPy and statsmodels.api. API is a suffix indicating we will import a large part of the stats models module. We will use the typical abbreviation SM for shorter. Good. After we have done that, we can load some housing data. It is information for 20 observations only. We have the size and price of houses, the state they are located in, the number of rooms that they have, and the year when they were constructed. Briefly, our first goal will be to regress a house's size on its price. In the previous lesson, we introduced the concept of univariate regressions. To run such a regression and explain the dependent variable house price, we will need only one independent variable, size. Hence, it will be convenient for us to focus on a table with only two columns, referring to a house's price and its size respectively. We can use the names of the columns of interest and type them in with double brackets, which will lead us to the desired output. Great! Python allows us to follow a very intuitive procedure for running a regression. We assign the data in the house size column to a variable we will call x. This information will stand for independent variable. Instead, y will refer to the house price data. Okay, let's check what we have got here. A couple of objects containing 20 elements each. These are the values stored in the x variable. While here, we have the house prices of each observation. Perfect! Matplotlib helps us project our data in a graph. Let's use the scatter plot. All data points will be scattered in this chart. This point, for instance, will refer to a house that has a size of 1,400 square feet approximately, and to a price of $820,000. That point instead corresponds to a house that has a size of 1,600 square feet and that has a price of $1,100,000. You see? This is how we can interpret the position of any of the 20 points we see in the graph. Is there anything we should be careful about? Yes, I am extremely cautious about one aspect. Let me tell you. Presented this way, the chart may delude the reader. The reader might think this house here is ridiculously small and doesn't cost much, while that one in the other corner is super expensive and huge. If you pay close attention to the numbers shown along the axes, you may then understand there is something wrong. Therefore, the first piece of advice I would like to give you is that the axis method allows you to set the start and the end values of the axes in the following way. Start and end value of the x-axis, the horizontal axis, the one of the independent variable, and then start and end value of the y-axis, the vertical axis, the one of the dependent variable. I know that in this sample, we don't have a house that is bigger than 2,500 square feet or more expensive than $1.5 million. So, 0, 2,500, 0, and 1.5 million will adjust the graph accordingly and provide us with enough space so we can plot our observations. Lovely! I hope you agree the picture looks much better now. We can see that even the smallest of the houses in our sample costs a lot of money, and we can get a better idea about the size-to-price ratio of our data. There is a little extra improvement that we can add to this graph. I would like to emphasize that when creating a professional graph, practitioners prefer to label the axes. plt.ylabel will add a label along the y-axis, and plt.xlabel will place a specified block of text below the x-axis. Thus, even if you had made no prior analysis of the data, a graph could tell you a lot. Do you agree? You can immediately understand it represents a relation between the size of a house and its price. Creating a good visual representation of a dataset is worth more than 1,000 complex calculations in certain situations. For this reason, we devoted more time to showing you how to improve a chart. In our next video, we will run a regression in Python. See you there.
Great. So we're doing good, actually. We explained what a regression is and how it helps us predict the development of certain variables. In this lesson, we'll dig deeper and learn how to distinguish between regressions that are reliable and regressions that do not explain a large enough portion of the variability of the dependent variable. Are you ready? Good. Let's start then. We know for a fact that more than one variable determines the development of house prices. Yes, size is important. However, there are other important factors, such as location, neighborhood, year of construction. All these characteristics influence the price of a house. So, a simple regression containing only one variable will omit some important factors and will likely provide an estimate deviating from the actual price. This doesn't mean a simple regression isn't useful, because it can still have a high predictive power. However, we need to know it won't provide us an equation capable of estimating house prices with absolute precision. We can expect an error, and the regression model can be written as y equals alpha plus beta times x plus error. When we talk about sample observations, the errors are called residuals. In the XY plot from earlier, we can draw straight lines connecting the best fitting regression line and the actual data points. And the distance of these lines will give us the residuals. The best fitting line is a best fitting line because it minimizes the squared sum of the distances of these residuals. If you draw a different line in this plot, its squared residuals will be higher than the sum of the squared residuals of the best fitting line. This is the reason coefficients found with this technique are called OLS estimates. OLS stands for ordinary least squares. We need to find a line that minimizes the distance between itself and the actual data observations we are using to calculate a regression. Right, so that's how we calculate regression coefficients and an equation that allows us to predict the independent variable. Before creating a regression, use your intuition. We need to think of the following question. Are all regressions equally good? Are there explanatory variables that do a better job in describing certain independent variables? There are. House size is one of the best indicators of house prices. Therefore, it makes sense to explore the relationship between the two variables through a regression. Does it make sense to use a regression between owner's age and house prices? Probably not, right? We don't expect buyers will be influenced by the age of the people who sell a house. Therefore, by definition, we can say all regression equations are not made equal. Some have an explanatory power higher than others. We need a tool that would allow us to measure such property and enable us to distinguish regressions with good, reasonable, and poor explanatory power. Fortunately, statisticians have come up with a tool that's easy to understand. It is called R-square. To understand R-square, we need to think of the total variability of the data, which is the measure for data dispersion and variability. Variance, right? Okay, so we'll use a concept very close to the one of variance, total sum of squares. TSS provides a sense of the variability of the data. The formula for the variance is the same, but n minus 1 is omitted. We've already calculated the sum of the squared residuals to obtain the regression coefficients. Therefore, we can obtain R-square with the following formula. 1 minus SSR divided by TSS. Typically, R-square is looked at as a percentage value, and it can range from 0 to 100%. The higher it is, the greater the explanatory power of the regression model. Typically, a simple regression with an R-squared of less than 10% has little predictive value. One-variable regressions with an R-squared of 30% or more are solid indicators of future performance.
All right, excellent. In the previous lesson, we learned how to plot data on a graph. As expected, now we will run a regression and will then focus on the interpretation of some statistics that can be obtained after running the regression. The Stats Models module contains tools for running a regression. The procedure to follow needs you to include a constant. We will assign the newly obtained information, which is the object x, and the constant to a new variable. Let's call it x1. Right after that, we will assign to another variable, reg, the output of an ordinary least squares regression, OLS. As arguments, we must add the dependent variable y and the newly defined x1. And, at the end, we will need the fit method, which you can think of as a method that will apply a specific estimation technique to obtain the full fit of the model. Finally, reg.summary will display the OLS regression results and will organize them in 3 tables. As you can see, we have many statistics in front of us. This is great, but we have to prioritize and will not focus on all of them. At the top, we always see the name of the dependent variable and the type of regression we have run. In our case, we are trying to explain house price levels, and the method we are using is least squares, hence the name of the model, OLS, standing for ordinary least squares. The R-squared value we talked about is shown in the top right corner. 0.678 means that the independent variable in our regression, house size, can explain 68% of the dependent variable, house price. This value is a lot greater than 30%, so we can affirm our model has good explanatory power. Thus, it is a good model. House prices are, in fact, explained largely by house sizes. The next table is the one we are interested in the most. The first row contains results regarding the constant we added. Sometimes, Python provides the results in scientific notation. This is the case for the number of the obtained coefficient. Anyway, it equals approximately 260,800, and this is our alpha. In fact, it is also the intercept in our regression. This means when we draw the regression line, the starting point of that line on the y-axis will be 260,800. All right, let's move on to the next row. How should we interpret the obtained coefficient of $402? It means that for every square foot increase of the size of a house, its price is expected to rise by $402. Namely, this coefficient is the value of beta in our regression equation, or the slope of the regression line. On the other hand, the standard error of $65 tells you this augmentation of $402 will typically vary within a range of $65. Let's see if this logic is correct. Per our regression output, which relies on the classical OLS regression equation, we can expect a house with a size of 1,000 square feet to equal alpha, which is $260,800, plus beta, which is equal to $402 times 1,000. The output of the equation as constructed is given by $662,800. When we go back to the graph we created in our previous Python lecture, we see there are two 1,000 square feet houses whose prices are only slightly lower than the one we predicted, $662,800. Therefore, our prediction fits well with the actual data. Before we finish this lecture, a note on Python. The Stats Models library allows us to apply a complete OLS model that provides 3 tables with multiple statistics. Alternatively, SciPy's linRegress allows us to extract 5 of these statistics very quickly. The slope, beta, the intercept, alpha, the R-value, the p-value we will soon introduce to you, and the standard error. In addition, the values are floats and are readily available for further calculations. Please don't forget to raise the R-value to the power of 2 to obtain the well-known R-squared statistic. The other values are the same as the one we saw in the earlier regression output, right? The slope is $402. The intercept, around $260,800. And the standard error, $65. We will learn about the p-value in the lesson where we introduce multivariate regressions. The exercise attached to this lecture is very interesting. You will need to manipulate some of the 5 statistics obtained with linRegress to solve it. Good luck, and thanks for watching.
In 1952, Harry Markowitz published a paper which was one of the most powerful academic breakthroughs we've seen in the world of finance. His work changed the way financiers look at their portfolios and formalized an intuition previously suggested by some practitioners. Investors shouldn't put all of their eggs in one basket. Markowitz proved the existence of an efficient set of portfolios that optimize investors' return for the amount of risk they are willing to accept. One of the most important highlights of his work is that investments in multiple securities shouldn't be analyzed separately, but should be considered in a portfolio, and financiers must understand how different securities in a portfolio interact with each other. We already know how to measure the relationship between two securities by calculating their covariance, and that's precisely what Markowitz suggested. Through the combination of securities with low correlation, investors can optimize their returns without assuming additional risk. Markowitz assumes investors are rational and risk-averse, so they are interested in earning higher returns and prefer avoiding additional risk. This leads to the conclusion that, for any level of risk, investors will be interested only in the portfolio with the highest expected return. Let's assume only two companies exist in an economy. Investors can use their shares to form portfolios. We have share A with an expected return of 7%, standard deviation of 5%, and share B with an expected return of 9% and a standard deviation of 8%. The correlation between the two shares is 0.3. A positive relationship means the two securities will likely change in the same direction. At the same time, 0.3 is far from 1, and we can benefit from a diversification effect when we include the two securities in a portfolio. All right, perfect. We know how to calculate the expected return and standard deviation of a portfolio, don't we? Let's do the following exercise. We can calculate the return of 6 portfolios composed of these two stocks. The first portfolio will contain 100% of stock A and 0% of stock B. The second portfolio will contain 80% of stock A and 20% of stock B, while the third portfolio will be made of 60% of stock A and 40% of stock B. The fourth portfolio, 40% of stock A and 60% of stock B. The fifth portfolio, 20% stock A and 80% stock B. And the last portfolio will contain only stock B. Okay, excellent. Let's calculate the expected return and standard deviation of these portfolios. Expected return is easy, isn't it? We only have to multiply the respective portfolio weights by the expected returns of the two securities. And this gives us the expected return of portfolio 1. It is equal to the expected return of security A, given that portfolio 1 is entirely made of security A. Good. I can copy downwards and obtain the expected returns of the other 5 portfolios. The standard deviation of a portfolio is more complicated, but not much. Let's apply the following formula. We have the portfolio weight of security A squared and multiplied by the variance of security A, plus the portfolio weight of security B squared and multiplied by the variance of security B, plus 2 times the correlation coefficient between stocks A and B multiplied by the weights of the two stocks, multiplied by the standard deviations of the two stocks. This is the diversifiable component of the portfolio. The lower the correlation coefficient, the greater the diversification effect that the combination of two stocks will have. To obtain the standard deviation of the portfolio, we'll need a square root of this number. All right, great. We've obtained expected returns and standard deviations of the 6 portfolios. Let's plot these in a 2-axis chart. The horizontal axis will contain the risk of the portfolio, and the vertical axis will show us its expected return. We've obtained the typical shape of a Markowitz efficient frontier. This is precisely what Markowitz suggests. There is a set of efficient portfolios that can provide a higher expected rate of return for the same or even lower risk. This group of portfolios is called the efficient frontier. Its starting point is the minimum variance portfolio, the lowest risk an investor could bear. Points below the efficient frontier represent inefficient portfolios, as for each we can find an alternative portfolio with greater expected return for the same level of standard deviation. Okay, great! We understood the main idea that earned Harry Markowitz a Nobel Prize. In our next lesson, we'll examine a universe with more than 2 stocks. You'll see the calculations we performed here hold true when there are more than 2 stocks investors can choose from. That's it for now. Thanks for watching.
Okay, great. Get ready. In this lesson, we'll carry out a great Python exercise. We will learn how to calculate the efficient frontier of a group of portfolios composed of 2 assets, Procter & Gamble stock and the S&P 500 index. If you think getting there will be too complicated, don't worry. We will break down all the steps in an easy-to-understand way. The whole idea of portfolio efficiency will become much clearer to you. Are you excited? Perfect. Let's get started. The first thing we'll do is import the libraries and modules we typically use in our analyses. In addition, we will import matplotlib inline. This is a feature provided by IPython, available exclusively for the Jupyter Notebook. It facilitates plotting matplotlib graphs just below code cells and storing them in the notebook document. We'll be able to import this module by typing $matplotlib inline. The 2 assets of interest are P&G and the S&P 500, both stored in a list called assets. We will use data for the past few years, starting from year 2010. All right, done. We proceed with a few standard steps, normalizing to 100 and plotting the portfolio data on a graph to see how the 2 assets have been performing throughout the time of interest. Okay, so if we want to obtain an efficient frontier composed of these assets, we will need their log returns. Then, we will need their average and their covariance and correlation matrices. Okay, we can easily see P&G and the S&P 500 had a solid rate of return during the time frame we considered, and the returns are well correlated. Good. Now, we'll address portfolio optimization from a technical perspective. First, we must create a variable that will carry the number of assets in our portfolio. We will use it in our formulas, so they can respond to a change in the number of assets that compose the portfolio. It will equal the number of elements in the assets list. We can obtain this number with the help of the len function. In our case, we are talking about 2 assets, PG and S&P 500. Okay. Now, we must create 2 random weights, right? NumPy_random could generate 2 floats between 0 and 1. We run this code and we obtain 2 new values. Awesome! In the next cell, I combine the 2 values of this array to see their sum. You see, they don't add to 1. I hope you agree I must rerun these cells too many times if I want their sum to equal 1, right? Here is what we can do instead. In the first line, simply assign two random numbers between 0 and 1 to the new NumPy array called weights. The trick is to add a line of code that comes afterward. In the loops section, we introduced incrementing. Can you recall what it was? And do you remember the syntax plus equality could be used to designate we want the variable on the left side to be reassigned with the same variable, plus the value of the expression on the right side. The logic is identical with the distinction that the arithmetic operation is not summation, it is division. Weights will be defined as a variable equal to weights divided by the sum of these weights. Still hard to believe this will make the sum of the two randomly generated values equal to 1? Please don't forget, weights is an array. This means, with the second line of code, we turn the values of our array to W1 over W1 plus W2 and W2 over W1 plus W2, respectively. Well, when we sum these two, we will obtain W1 plus W2 over W1 plus W2, which equals 1. Let's see. Yes, absolutely. Therefore, remember this cell, specifically this line of code. It enables you to obtain two randomly generated weights whose sum will always equal 1. Great! I consider this lecture a preamble to the next one, which is the crux of this financial lesson, the Markowitz mean variance theory. See you in the next video. Great job so far. Now, let's push our analysis a few steps further. What follows is writing the formula for expected portfolio return. It is given by the sum of the weighted annualized average log returns. Wow, this sounded too complicated, but mathematically, it is simple. Just don't overlook this was not the built-in sum function. NumPy has an analogical method that enables summation of values in multidimensional objects, which works perfectly for our situation. So the correct syntax starts by numpy.sum. Okay. The two cells that follow are a refresher. This is the code that will provide the expected portfolio variance and volatility, respectively. Fine. We went through these three cells because we will need the formulas for the return and the volatility in the simulation of the portfolio's mean variance combinations. Yes, that's right. We will create a graph where 1,000 mean variance simulations will be plotted. Therefore, remember the following note, as it is very important. We are not considering 1,000 different investments composed of different stocks. No, we don't do that. We are considering 1,000 combinations of the same two assets, P&G and S&P 500. This means we simulate 1,000 combinations of their weight values. Out of the 1,000 combinations, we will probably have a portfolio composed of 1% P&G and 99% S&P 500, and a portfolio composed of 99% P&G and 1% S&P 500. The idea is to compare the two and see which one is efficient. Okay. In the next cell, the focus is not so much on the code. Try to grasp the reasoning that explains the flow of the related operations. We said our goal is to create a graph that visualizes the hypothetical portfolio returns versus volatilities. Therefore, we will need two objects where we can store this data. So, portfolio returns starts as an empty list we intend to fill with randomly generated expected returns. We apply the same instruction for the portfolio volatilities. Fine. we will need a loop that will be repeated 1,000 times. Here, you see how useful the range function can be, right? In the loop body, we will randomly generate two weights whose sum equals 1. We need two weights because, as we already mentioned, the portfolios comprise two assets. Should its components be over 2, for instance 5, the number of weights generated will be 5. Okay. The next two lines of code are of paramount importance. The key is the append method that will add each newly generated portfolio return value to the list portfolio returns. And this operation will be repeated for each pass of the loop until the portfolio returns list accumulates 1,000 observations. Since we are calculating expected future portfolio return, in the parentheses, we had to insert the formula we mentioned a few minutes ago. On the next line, we repeat the same procedure for portfolio volatilities. We will use the append method and apply the formula for standard deviation. Perfect. Let's see what the portfolio returns and the portfolio volatilities look like. We won't count the number of values, but apparently, these are two super long lists containing 1,000 values each. Anyway, we are on the right track, but we are not quite there yet. First, these lists are hard to manipulate. The third secret we would like to show you is how you can convert these lists into NumPy arrays. We will call these arrays the same names. The syntax is intuitive, and you know it well by now. Just don't skip this important step when plotting the efficient frontier. Right. Now, we can see the two variables have been organized differently this time. They are arrays. Awesome! In the next video, we will plot the results on a graph. Thanks for watching. In the previous two lectures, we did most of the heavy lifting. Now, we'll complete the exercise and see the output of our work. First, we will create a data frame object containing two columns, one for returns and another one for their respective volatilities. We will call this object portfolios. Its data will be composed of a dictionary with keys, return, and volatility. These names will be automatically assigned as column names. The data contained in the entire portfolio returns and portfolio volatilities arrays will constitute the two key value pairs and will fill in the two columns. Perfect. A quick check with the head and tail methods shows us we did everything right. Very good. Congratulations! You made it to the last cell of this long exercise. Here comes the matplotlib syntax you need. From the portfolio's data frame, plot data on a graph with an x-axis corresponding to the volatility column and with a y-axis corresponding to the return column. An important specification is what kind of graph we want to insert. In our case, we will need a scatter plot. After that, I love adjusting the size of the chart, so I'll also add a fig size of 10 and 6. Last, stay true to your professionalism. Assign meaningful x and y labels to the graph. For example, expected volatility and expected return. Beautiful! This is the efficient frontier, right? Is there anything else to say? We made it! Please go through the notebook file to solidify the tools we presented in this lecture. In the exercise attached, we will ask you to go through the entire process on your own. Thanks for watching.